Most farmers don't go broke because of one catastrophic season. They go broke because of a series of small, invisible financial decisions that quietly stack against them over time. Decisions that seem harmless in isolation. Decisions that feel routine. Decisions that don't trigger any immediate consequence. And one of the most expensive of all those decisions? Crop insurance. Every year across the United States, farmers sit down with an agent, review a few numbers, glance at last year's policy, and make a renewal decision in under an hour. That decision controls the financial outcome of their entire season. And yet, it's treated like paperwork. No deep analysis, no scenario modeling, no stress testing, just habit. That's where the problem begins. Because agriculture today is not the same as it was 10 years ago. Input costs have surged. Fuel, fertilizer, seed, labor. Everything costs more. Commodity prices swing harder. Markets react faster. Global supply chains amplify volatility. Weather patterns are less predictable. Risk is no longer seasonal. It's constant. And in the middle of all that chaos, most farmers are still using insurance strategies designed for a simpler time. That disconnect is where the $50,000 mistake lives. Not in dramatic failure, but in quiet misalignment. Let's break it down with a real scenario. Two farmers, same county, same soil, same crop, same planting window, both grow corn, both choose 75% coverage, both believe they are protected. But there's one difference. Farmer A selects a pH, actual production history. Farmer B selects revenue protection. On paper, both look similar. Same percentage, similar premium range, same sense of security, but they behave very differently under pressure. Mid-season, drought stress reduces yields by about 18%. At the same time, regional shortages push corn prices up by 20%. Now the system gets tested. Farmer A's APH policy looks only at yield. Their payout is based strictly on lost bushels. It does not care that the price increased. It does not adjust. It does not compensate for the market shift. Farmer B's revenue protection policy recalculates based on both yield and price. The higher market price actually increases their insured revenue guarantee. Their payout reflects real financial loss, not just physical production loss. Same field conditions, same weather, same decisions up front, except one detail. Two completely different outcomes. Farmer A absorbs volatility. Farmer B transfers it. And that difference? It's not small. Across enough acres, it becomes $30,000, $40,000, sometimes $50,000 in a single season. Now here's the uncomfortable truth. Farmer A didn't make a reckless decision. They made the most common decision in American agriculture. Because most farmers choose crop insurance based on what they used last year, what their neighbors are doing, what their agent recommends, what feels familiar, not based on financial modeling, not based on worst-case scenarios, not based on how the policy behaves when everything goes wrong. And that's not because farmers are careless. It's because the system is built in a way that encourages routine. It's complex enough to confuse, but simple enough to create a false sense of confidence. You feel protected, until you're not, and by the time you realize it, the season is over. There are no adjustments, no second chances, no retroactive fixes. That's why this topic matters more than most farmers realize. Because crop insurance is not just protection, it's strategy. It defines your downside. It shapes your risk profile. It determines whether a bad year is survivable or financially damaging. And in modern agriculture, survival is not about avoiding bad years. It's about managing them. In this series, we're going to break this down properly. No fluff, no theory. We're going to expose where most decisions go wrong. Why yield-based protection is outdated in volatile markets. How revenue-based systems actually calculate your risk. Why your coverage level might be the most expensive mistake you're making. And how serious operators are using data, not habit, to make these decisions before signing anything. Because the next bad season isn't a possibility. It's a guarantee. And when it hits, your insurance policy won't be a document. It will be the difference between stability and loss. There was a time when farming risk was simple. You either produced, or you didn't. Rain came, you made money. Rain didn't come, you lost money. And crop insurance was built for that world. That's where APH, actual production history, comes from. It was designed to protect your yield based on historical averages. A clean, logical system for a simpler era. But here's the problem nobody likes to admit. That era is gone. Modern agriculture is no longer a yield game. It's a margin game, and margins are driven by two forces, production and price. APH only understands one of them. Let that sink in. You are running a business where your income depends on two variables, and your insurance only tracks one. That's not protection. That's partial coverage dressed up as security. Let's break this down in a way most farmers never actually calculate. You plant corn. Your APH sits at 180 bushels per acre. You lock in 75% coverage. That gives you a guaranteed yield of 135 bushels. So far, everything looks controlled, predictable, safe. Now let's stress test it. Scenario 1. The silent loss year. You harvest 150 bushels per acre. Above your guarantee, so insurance doesn't trigger, but prices drop from $5 to $3.50. Your revenue collapses. You didn't lose production, you lost money. APH does nothing. Zero. Because in its world, you succeeded. In reality, your margins got crushed. That's the first failure point. APH cannot detect financial loss unless it comes from yield. Now scenario 2. The false compensation year. You harvest 130 bushels. Below your guarantee, APH triggers a payout. Sounds good, but now prices rise from $5 to $6.20. Your crop is worth significantly more. Your revenue might actually be fine, or even strong. Yet the policy still pays out based purely on lost bushels. Now it's overcompensating. You're being paid for a loss that doesn't really exist in financial terms. That's the second failure point. APH doesn't align payouts with real-world income. Now scenario 3. The double hit year. This is the one that kills margins. Yield drops to 140 bushels, still above your guarantee. No payout. At the same time, prices drop 25%. Now you're hit on both sides. Lower production than expected, lower price than expected, revenue gets squeezed hard. APH still does nothing. Because technically, you didn't cross the yield threshold. This is the moment most farmers realize something is off. But by then, it's harvest. There's no adjustment, no correction, no safety net, just a quiet financial hit that gets blamed on a tough year. But it wasn't just a tough year. It was a mismatch between your protection and your actual risk. And this is where things get uncomfortable. Because APH doesn't fail loudly. It fails silently. It doesn't wipe you out in one shot. It slowly erodes your margins over time, year after year, until one season finally exposes the gap. And by then, the damage is already done. So why do so many farmers still stick with it? Because human behavior is predictable. And not in a good way. First, habit. If something hasn't visibly failed, it feels safe, even if it's quietly underperforming. Second, simplicity bias. Farmers prefer systems they understand. APH is easy. It's linear, no moving parts. That simplicity creates confidence, even when it shouldn't. Third, cost illusion. APH is usually cheaper upfront, so it feels like a smart financial decision. But here's the reality most people avoid. Cheap insurance is only cheap if it works when you need it. If it fails in high-risk scenarios, it becomes the most expensive decision you made all year. Fourth, advisor influence. Many insurance agents default to APH because it's easier to explain and close. Not because it's optimal for your operation. And unless you're pushing back with data, you inherit that default. Now let's zoom out. Agriculture today is exposed to global commodity swings, geopolitical supply shocks, input price volatility, weather unpredictability, market speculation, and yet, a large portion of farmers are still using an insurance model built for a yield-only world. That's like running a modern farm with a 1990 risk strategy. It works. Until it really doesn't. And here's the part that matters most. You won't notice this problem in a good year. You won't notice it in an average year. You will only notice it in a volatile year. The exact year when protection actually matters. That's the trap. APH gives you confidence during stability, and exposure during instability. And modern agriculture? It's built on instability. If your protection doesn't evolve with that reality, your margins become vulnerable. Not immediately, but inevitably. Revenue protection sounds complex. Good, because your risk is complex. And any system that claims to simplify that completely is probably hiding something. Revenue protection, or RP, was created to fix the exact blind spot that APH leaves open. It doesn't just look at how much you produce. It looks at what your production is worth. That sounds obvious, but in practice, it changes everything. At its core, RP combines two variables, yield and price. And instead of locking your protection into a fixed assumption, it allows your guarantee to move with the market. That's the key difference. APH is static. RP is dynamic. Let's walk through this step by step, because this is where most farmers think they understand it, and don't. At the beginning of the season, a projected price is established. This is not random. It's based on futures market averages during a specific window. For corn, this often comes from CME futures pricing. Yes, that Chicago Mercantile Exchange you've heard about but probably don't actively think about when signing insurance papers. Let's say that projected price is $5 per bushel. Now we build your guarantee. Your APH is 180 bushels per acre. You choose 75% coverage. So your baseline revenue guarantee is 180 times 0.75 times $5 equals $675 per acre. That's your starting point. Now here's where RP starts to separate itself. At harvest, a new price is calculated. Again, based on market data. Let's say that price moves. Two directions matter here. If the harvest price drops below $5, your guarantee stays at $675. It doesn't go down. You're protected against price drops. But if the harvest price increases, everything changes. Let's say it rises to $6. Now your guarantee is recalculated. 180 times 0.75 times $6 equals $810 per acre. Read that again. Your protection just increased without you doing anything. Same policy, same acres, same decision, but now your downside coverage is stronger because the market moved. That's not a small feature. That's the entire advantage. Now let's stress test this system. Scenario 1. Yield loss plus price increase. You harvest 130 bushels per acre. Price at harvest is $6. Your actual revenue, 130 times $6 equals $780 per acre. Your guarantee, $810. You're below it. RP pays the difference. Your loss is covered in a way that reflects real market conditions. APH wouldn't even see half of this. Scenario 2. Yield stable plus price collapse. You harvest 175 bushels. Above your yield expectation, but prices fall to $3.80. Your revenue, 175 times $3.80 equals $665. Your guarantee, $675. You still trigger a payout. Because RP recognizes that your income dropped, even though your production didn't. That's alignment. That's what risk management is supposed to look like. Scenario 3. Strong yield plus strong price. You harvest 185 bushels. Prices rise to $6.20. Your revenue explodes. No payout. And that's exactly what you want. Insurance is not there to boost good years. It's there to stabilize bad ones. Now here's where most farmers mess this up. They look at RP and think, sounds good, but it's more expensive. And they stop there. That's amateur thinking, because you're comparing cost, not outcome. The correct comparison is this. How does each policy behave under stress? Because that's when it matters. If your cheaper policy fails in a high volatility year, you didn't save money, you delayed a loss. And here's something most agents won't explain clearly. RP is not just protection. It's leverage, because it allows you to participate in favorable price movements while still protecting your downside. It aligns your insurance with your revenue reality. And in modern agriculture, that's not optional anymore. It's necessary. Now, is RP perfect? No. It has limitations. Premiums are higher. Understanding it requires effort. And if you choose the wrong coverage level, you can still leave gaps. But compared to APH, it's operating in the same world your farm actually exists in. Price plus production, not just production alone. And that's the shift from thinking like a producer to thinking like a risk manager. Because at scale, farming is not just about growing crops. It's about managing exposure. And revenue protection is one of the few tools that actually reflects that reality. By now, you already understand something most farmers don't. Choosing the right type of insurance matters. But here's the part that really hurts margins. Even if you pick the right policy, you can still get crushed by choosing the wrong coverage level. And that mistake is way more common than people like to admit. Because coverage level feels like a preference decision. It's not. It's a financial exposure decision. And most farmers treat it like they're adjusting volume on a radio. 70%, 75%, maybe 80% if they're feeling bold. Based on what? Comfort, premium cost, what the neighbor is doing, not on actual risk modeling. That's where the trap is. Because your coverage level defines one critical thing, when your protection actually starts working. And most farmers set that trigger way too low. Let's break it down clean. Same operation, APH, 180 bushels. Projected price, $5. Now compare two decisions. Farmer A chooses 75% coverage. Farmer B chooses 85% coverage. Let's calculate the guarantees. Farmer A, 180 times 0.75 times $5 equals $675 per acre. Farmer B, 180 times 0.85 times $5 equals $765 per acre. That's a $90 difference per acre in protection. Now scale that across 500 acres. That's $45,000 of additional downside protection. Same farm, same crop, same season, just a different decision on coverage level. Now here's where reality hits. Most bad years don't destroy 40% of your yield. They chip away 15%, 20%, maybe 25%. And if your coverage is too low, insurance never triggers. You absorb the entire loss. Let's simulate it. You run 75% coverage. Your guarantee sits at $675. Your season ends with revenue at $700 per acre. You feel the pressure. Margins are tight, but insurance doesn't pay, because technically, you're above the threshold. Now look at the same scenario under 85% coverage. Your guarantee is $765. Your actual revenue is still $700. Now you trigger a payout. That gap? $65 per acre. Across 500 acres? $32,500 recovered. Same year, same performance. Two completely different financial outcomes. And this is where most farmers get stuck. They look at the premium difference. Because yes, higher coverage costs more. That extra 10% isn't free. So they hesitate. They think, I'll save on premium and take a little more risk. Sounds reasonable, until you realize what's actually happening. You're self-insuring the most common loss scenarios. Not the catastrophic ones, the normal bad years. And those are the ones that happen the most. This is the part nobody explains clearly. Lower coverage does not protect you from typical volatility. It only protects you from extreme disaster. And extreme disaster is not what usually kills profitability. It's the accumulation of average bad years. That slow bleed, that consistent underperformance, that's what drains operations. And low coverage levels are perfectly designed to let that happen. Now let's talk behavior again. Why do farmers consistently underinsure? First, premium anchoring. They fixate on the upfront cost. How much more does 85% cost me? Instead of asking, how much risk am I removing? Second, optimism bias. They assume the year will be average or good. so they downplay the probability of loss. Third, cash flow pressure. Higher premiums feel like immediate pain. Losses feel like future problems. Humans always discount future pain. That's not strategy. That's psychology. Fourth, lack of scenario analysis. Most farmers never actually run the numbers. They don't simulate outcomes across different coverage levels. So they're making decisions blind. Now here's how high-level operators approach this. They don't start with cost. They start with exposure. They ask, at what revenue level does my operation start to feel stress? Where is my break even? What level of loss can I absorb without damaging the business? Then they work backwards. They choose coverage that protects that threshold, not coverage that feels affordable. Because affordability is irrelevant if the policy fails when you need it. And here's the brutal truth. Most farmers are underinsured for the risks they actually face. And overpaying for protection they rarely use. That's the worst combination. Now let's zoom out. Crop insurance is not about guessing the future. It's about controlling the outcome range. And your coverage level defines that range. Too low? You absorb too much volatility. Too high? You might overpay for protection you don't need. The goal is not maximum coverage. It's optimal coverage. But you don't find optimal by guessing. You find it by modeling, by stress testing, by running numbers across different scenarios before you sign anything. Because once the season starts, you're locked in, and the market doesn't care what you meant to protect. It only cares what you actually did. At this point, you already see the pattern. Most farmers are not losing money because they don't have insurance. They're losing money because their insurance decisions are not aligned with how their operation actually makes money. And the difference between average operators and top-tier operators? It's not luck, it's process. Serious operators don't choose crop insurance. They engineer it. Before they sign anything, they run scenarios. Not one, multiple. Because a single scenario tells you nothing. Farming doesn't operate in straight lines. It operates in ranges. So they simulate outcomes across different conditions. Low yield plus low price. Low yield plus high price. High yield plus low price. Stable yield plus volatile price. And then they compare how each insurance structure behaves inside those scenarios. APH versus revenue protection. 70% vs 75% vs 80% vs 85%. They're not asking, what's the cheapest option? They're asking, which structure keeps my operation stable across the widest range of outcomes? That's a completely different mindset. Now here's where tools come in. Most farmers think they don't have access to this level of analysis. They do. They just don't use it. Programs connected to the United States Department of Agriculture provide historical yield data, price trends, and simulation frameworks that allow you to test your decisions before committing. Not guess. Test. You can literally model your farm's exposure. But here's the catch. The tool doesn't make the decision. You do. And most people avoid it because it requires effort. It forces you to confront uncomfortable scenarios. It shows you where your operation is weak. And that's not fun, but it's necessary. Now let's talk about how high-level operators structure their thinking. Step 1. Define the break-even point. Not emotionally, numerically. At what revenue per acre does your operation start losing money? That's your danger zone. If you don't know this number, you're not managing risk. You're guessing. Step 2. Define acceptable loss. Every operation can absorb some level of volatility. The question is, how much? 5%? 10%? 15%? Beyond that, you're not just having a bad year. You're damaging the business. Step 3. Align insurance with that threshold. This is where most farmers fail. They pick coverage first, and only later realize it doesn't protect their break-even. Smart operators do the opposite. They set the threshold first, then choose the policy and coverage level that protects it. Step 4. Compare scenarios, not premiums. Premium is just the price of entry. Outcome is what matters. If policy A costs less but exposes you to a $40,000 loss, and policy B costs more but caps your downside, policy B is not more expensive. It's more efficient. Step 5. Make the decision once, correctly. Most farmers revisit insurance every year, but never actually improve their decision. They just repeat it. High-level operators build a system. Once they find the structure that aligns with their operation, they refine it. They don't restart from zero every season. Now let's address something directly. There is no perfect policy. There is no universal, best choice. APH is not useless. Revenue protection is not magic. Coverage levels are not one size fits all. Everything depends on your operation, your cost structure, your risk tolerance, your crop mix, your market exposure. But here's what is universal. If you are not modeling your risk, you are not managing it. You're just hoping things work out. And hope is not a strategy. Now let's bring this full circle. The $50,000 mistake is not choosing APH. It's not choosing the wrong coverage level. It's not even choosing the wrong policy. The real mistake is this: making one of the most important financial decisions of your season without understanding how it behaves under pressure. Because crop insurance only matters in bad years. And bad years don't give second chances. So the real question isn't, what policy should I choose? It's, what outcome am I willing to accept if things go wrong? Once you answer that, the decision becomes obvious. And that's where you separate from the majority. Not by working harder, but by thinking differently, by treating your farm like what it actually is: a risk-managed business. Not just a production system.